Welcome back. You're still with us on Finweek Money Matters. The Rand is currently trading at its lowest level since 2002 and as the second most volatile emerging market currency in the world. It is sent into a frenzy in response to the slightest movements both domestically and abroad. But in studio with us to discuss the outlook for the Rand and its implications for the economy is Alex Smith, economist at First National Bank, and Dr. Adrian Saville, Chief Investment Officer at Cannon Asset Managers and Chief Strategist at Citadel. Gentlemen, thanks for your time. Adrian, let me start with you.
Sure.
If you go back to 2011, we were sitting at R6.60. Currently, we were sitting at around 12.50. Are these levels justified?
The economy suggests that these levels are absolutely justified. You've got an economy that's struggling to perform at potential. Potential economic growth is in the order of 3%. That potential is compromised right now by the electricity deficit. We are sagging in our competitiveness in the manufacturing sector. You only have to look at the mining and manufacturing data that was out yesterday, if my memory serves correct. And that shows that the productive sector of the economy is really struggling. A large current account deficit only helped this year not by improving exports but by improving imports, and that has been the gift of the lower oil price. Put all of that together and you don't have robust economic fundamentals, and that suggests the currency should be weaker rather than stronger. From there we could ask, what is the appropriate level? I think one of the most robust models for figuring out fair value of a currency is purchasing power parity.
Okay.
And that opens up a whole new debate.
We'll get into what a fair level is. Alex, a couple of pointers that Adrian alluded to is talking about the current account deficit, Eskom. These are internal factors, but I'm sure there are also external factors that have had an impact on the Rand.
Oh yes, without a doubt. I think the key external factor is commodity prices. Bear in mind that South Africa is predominantly a commodity exporting economy, and those commodity prices have a very significant impact on the Rand exchange rate. So, for example, if you look at the big four commodity exports in South Africa, which are iron ore, coal, gold and platinum, the price of all of those commodities in dollar terms is down significantly relative to a year ago. In particular, iron ore is down by about 50%, platinum price is down by around about 30%, coal by 20-odd%, and gold by about 15%. So when one considers that the Rand against the dollar has weakened by about 15% over the past year, in the context of such significant terms of trade depreciation or deterioration, actually it doesn't seem that bad. But as Adrian alluded to earlier, the lower oil price is helping somewhat in that regard. But certainly commodity prices being a significant factor. Also globally, what we need to consider is that the world economy is struggling right now. It's not just South Africa that's struggling, but the world economy. And as a result, global demand is quite weak. So South Africa is struggling to export. Even if we didn't have constraints in the manufacturing sector, we probably would struggle to export a lot of manufactured goods, because our key manufactured export destinations, i.e. Europe and Africa, are experiencing relatively weak growth at the moment. So it's a weak global demand environment, it's a weak global trade environment, and it's a weak commodity price environment, which is all relatively Rand negative. Having said that, though, there are some positives out there, and certainly one of them is that vehicle exports are performing quite well at the moment. So there are areas within manufacturing that are performing well, and overall export volumes are actually not doing too bad. So export prices are low, but export volumes are still holding up relatively well. And we saw that in the first quarter with export volumes of about 5%, or export volume growth of about 5%.
Mm-hmm. Adrian, Alex was talking about the fact that globally we are all in trouble here. The IMF brought out a global forecast to say that things aren't looking particularly great. But then when it comes to China and when it comes to Greece, they think that this may be contained. Janet Yellen is speaking later on tonight, and this is supposed to give us clues in terms of when we're most likely to see the Fed normalize interest rates. How big of an impact is this going to have for us today?
I think this is where the rand is particularly vulnerable. The current account deficit for the last 15 years has been funded mainly by portfolio flows, or what is more impolitely referred to as hot money. And the money can change its mind and leave at the press of a button. So it's gone in 60 seconds. The bulk of the current account deficit has been funded by those portfolio flows, which go into the likes of government bonds, listed equities, and other traded paper. If the US starts hiking rates, and the so-called dot plot gives us some clues about not necessarily their timing, but certainly their bias, and their bias is unambiguously to start tightening, the rand is particularly vulnerable to money deciding that, or capital deciding that it's time now to head to slightly higher interest rates. It is hard to think of just a modest interest rate adjustment being the basis for a cause of a wall of money to leave, but perhaps the first move gives you clues about the next moves. In and of itself, that interest rate, the first Fed interest rate hike, isn't enough to cause the money to leave. What will cause the money to leave won't then be the maths, but rather the sentiment.
Alex, given what Adrian has said and everything you said earlier to this, what are you thinking the rand may do in the next 6 months or so?
Look,
hard question.
For me, I'm not that, despite all the sort of negative sentiment that seems to have come out, I'm not that negative on the rand for a couple of reasons. So first off, it depends which currency you're comparing the rand to. So on a trade-weighted basis, I'm actually expecting the rand to remain relatively stable. And that's because we've got record monetary easing coming through in Europe and Japan, which are important trading currencies with South Africa. So we've got quantitative easing there, where the European Central Bank and the Bank of Japan are actually doing their best to debase their currencies at the moment and to weaken them. So as a result, the rand should probably hold up relatively well against those currencies. Against the dollar, I do imagine there will be some modest weakness, but one needs to bear in mind also that what is the Federal Reserve trying to achieve at the moment? Well, the Federal Reserve wants to gradually lift interest rates in an environment where inflation is still relatively low, and where they're still relatively concerned about the labor market in the US. They don't want to disrupt this nascent recovery before it actually has a chance to kind of stabilize and cement itself. And bear in mind what we saw earlier this year when the US dollar was actually very strong, is that the US economy actually underperformed. So the US economy is still dependent on the dollar, and a strong dollar does impair US exports, and it does have a dampening effect on US inflation. So what I anticipate will happen is that yes, the Fed will hike interest rates, the dollar will probably strengthen, but thereafter the Fed will probably come out and be quite dovish and try and talk the dollar down again, because they simply can't afford to have a dollar that's too strong, because it will hurt their recovery. So as a result, I don't anticipate that there will be significant rand weakness with respect to the dollar, simply because the US Fed cannot allow that to happen.
Adrian, with the fact that you are a chief investment officer, is going offshore now the right decision to make when it comes to your investment? What should one do?
Maybe an easy way to think about where to allocate your capital is to recognize the purpose of money that you've got put aside. If this is retirement capital and that is your only pot of money, and you take that money offshore at 12 to the dollar, and it does more than what Alex is suggesting. It doesn't just hang around at 12, it actually appreciates back to 6, which seems unimaginable, but remember the conversation in 2001 when people were anticipating the 20 rand dollar, and it went from 12 rand to the dollar back to 6. So if you take all of your capital offshore at 12 and you are wrong, it's a major capital misstep. So the one part of the what should I do with my capital is what do you need that capital to do for you? And this is referred to as asset liability matching. Another way to think about this is to imagine that you lived on Mars. And if you lived on Mars and wanted to have a great holiday, there are few places in the world that will give you more bang for your buck than South Africa. On that basis, ask any South African traveller if they found a cheap destination around the world. The only place on the Big Mac index that is cheaper than South Africa, in fact, I think there's two right now, it's the Ukraine and India. So on that basis, the rand looks like it should gather back some of the recent lost ground. What I wouldn't do is I wouldn't invest on the anticipation that my forecast for the currency is right. Because if you want to be wrong, forecast a currency. And if you're building an investment decision on the back of, I'm buying this because the rand will go to that, you stand a better than even chance of being disappointed.
Alex, are there other factors that South Africans should be focusing on apart from the rand? There's this fixation on it. You did say there are positive shoots there. Exports are looking better. What else should we be looking at to try and fix our situation?
Yeah, look, I think there's a couple of things that, the rand is a reflection of the fundamentals within the economy. And so I think one should really think of it in that context rather than think of it as an indicator unto itself. And in that regard, we are seeing a relatively weak rand to some extent because, as Adrian spoke to earlier, the manufacturing sector is losing a bit of competitiveness. We've had very significant electricity tariff hikes over the last few years. Also, wages have gone up a lot in both mining and manufacturing. And there's also been quite a lot of labour unrest and so on, and fiscal deficits have been relatively large, so that's also created a certain degree of uncertainty around investing in the country. So I think as a country and from a public sector perspective, we need to focus on reducing budget deficits. We need to focus on improving ease of doing business, things like making it easier to export. South Africa is a very expensive place to export out of. The cost of exporting is high. The number of documents you require to export is high. So these are all, what us economists call, structural constraints that exist within the sort of manufacturing base and export base. And if we deal with some of these issues and certainly alleviate the electricity crisis, then we can see exports pick up quite a lot more. And I think there's also these other kind of low-hanging fruits that we can look to. For example, a very important source of export revenue for South Africa historically has been tourism. Now that's a service export, it's not something that we necessarily talk about that much. But more recently with the new visa requirements, we're actually hurting that area quite a lot. And just by making some small amendments there, we can actually support service exports a lot. And that's really a great one because it employs a lot of people. It's not energy intensive, and it's really quite an easy one to fix.
Unfortunately, we're going to have to leave it at there. Adrian, I know that you had done some research with regards to fair value with the DTI things. Just maybe if you can slot it in, the crux of your research in 20 seconds.
Sure. Well, two components. The one is that to ask for a weaker rand to help the manufacturing sector is mythical. There's simply no relationship between currency bolstering country competitiveness. And I think the other is to recognize then, as Alex has pointed out, that the remedy to the rand is really in structural issues.
Thank you so much, gentlemen, for joining me, talking about the rand and where to from here. A big thank you to Alex Smith, he's an economist at First National Bank, and Dr. Adrian Saville, Chief Investment Officer at Cannon Asset Managers and Chief Strategist at Citadel. That's it for this edition of Finweek Money Matters. Remember, you can get your copy of the latest edition of the magazine. It's in stores and it's also available online. From myself and the team, have a great week and we'll see you again next week.